Hi, this is Selland from Signet Mortgage. I appreciate you being here. I look forward to sharing some valuable stuff. And I expect you will share our excitement on what can be done to help clients with the strategic application of a reverse mortgage. Rika is also on. She will be helping out as she always does, but in this case, monitoring chat and keeping us on track. There will be a replay available for a short time, and the short time is so I can be sure everything is current and we don't have changes and all that sort of stuff that's dated. I'd like to handle questions as we go because the conversation is the best, but I may defer answers if we're going to cover it coming up. And so it's best to start with what's in it for you. Why are you here? And so that we can agree the investment you're making in time will be worthwhile. Number one, I'd like to get you a listing by helping a client expand the possibilities of where they can go, where they would like to go. If we expand those possibilities, they're more likely to say, yeah, I'll do it. Number two, getting a sale where a client was thinking about it, but now has a plan that's turned the outcomes much better than they thought. Third, maybe a referral fee for a client that's now confident in their plans to move. And sometimes just knowing what is possible means the client stays put. Okay, the house is appropriate and all of that, but they do so with confidence and gratitude for you being part of the solution and letting them know how they can make it happen. No one knows how long they'll live. It would be a lot easier to plan if we had a checkout time. The result is fears and uncertainty that retirees have and soon-to-be retirees have. Uncertainty is never comfortable. It's never our friend. Number one uncertainty, and they do polls for all this, can we stay in our home? Is it safe? Is it appropriate? Can we afford it? It doesn't have to be that way. Boomer housing wealth in this country is almost $12 trillion. California certainly has more than its fair share of that. Yet it's a generation that's kind of hell-bent to have a paid-off home and not sure how to access home equity safely. Think about this. If it was Apple stock in their portfolio that had appreciated like the housing market has, they wouldn't have they'd spend that in a heartbeat. Housing is treated differently. But you can help with that understanding. So let's go. Home equity, or a HECM for purchase, which is a home equity conversion mortgage, is what we'll talk about. Typical transaction utilizes partial proceeds from the sale of a current residence or their own funds, but generally the sale of current residence, and the HECM for purchase reverse mortgage to purchase a home. There, in the end, no required mortgage payment. So that's the primary goal. Get the house, no mortgage payment. Borrowers must be 62 or years of age or older for the standard program, or 55 for the proprietary jumbo programs, which we won't talk too much about, but they exist. What's in it for senior clients? They're typically thinking all cash, that their mindset is all cash. This allows a client to conserve cash when buying their retirement home and instead add those funds to investments. Or they would buy more home than they thought they could, or that they could afford, and maybe get the upgrades and that sort of thing. Senior clients do not think about a reverse mortgage. They simply don't want a mortgage payment. So they limit their own options without knowing. There's a quick example. This family sold a $750,000 home, paid off the mortgage, and covered the transaction costs and netted about $600,000. So with that $600,000, rather than being limited to an all-cash transaction, they were able to purchase a new home for $650,000. It was closer to the kids and on a golf course. Only $423,000 down payment was required from their $600,000. $227,000 was from the HECM for purchase program. That means $177,000 went into their investment. Again, still no mortgage payment. This is a transaction we closed late last year. The home was overwhelming for this family, or for this widow. No funds to address deferred maintenance, limited income, zero reserves. But she had $1.7 million in equity. So we developed a plan. She sold her home in Alamo. She has a beautiful new home in Brentwood with zero maintenance, brand new. She got the upgraded model. She's now closer to medical resources. And check this out. She was able to contribute $900,000 to her investments. And that's after paying capital gains, after the exclusion and all that. And she gets to take the property tax basis with her, so housing costs remain the same with the exception of the HOA. She has $900,000 at 82 years old to handle that, which she didn't have when she was still in Alamo. Okay, this is an amazing tool that can be used to improve even the most well-prepared plan. This example, selling an existing home and realizing a $750,000 net profit. That's what that's doing. Okay, I'm sorry, cash from the sale. What are their choices? Typically, client would be limited by the cash on hand because they don't want a mortgage payment. So we can't buy anything more than it's going to cost us $750,000. Or they could use a HECM for purchase loan, and they could buy the same home with a HECM for purchase loan and put $267,000 in their investments. Or they could upgrade the home a little bit, get the home they really, really want, and still put $141,000 away in investments and still no mortgage payment. So the clients appreciate you making it happen, and the result, more referrals, they tell their friends, we're both in it together, and that's a good thing. It works for jumbo too, upgrading the home and still putting cash away and still having no house payment. You can do this. The loan amount is up to $4 million, so it's it can handle the more expensive transactions too. And this well-prepared client, this is an example we did. Their choices, they were sinking cash. We did it with a reverse mortgage, and they were able to put $450,000 into, or keep it in investments, is actually what they did. Now, the costs are lower for the jumbo program, but the rate's much higher. So we have to pay attention to that. And we're in a little bit high interest rate environment right now, so we have to pay attention to that. Anyhow, we want you to be the hero and have this in your toolbox. The rules. This is an FHA HUD loan, okay, government administered and guaranteed. So there are some rules, of course. Borrowers have to be 62 years of age or older. It has to be a primary residence. If it's a condo, it has to be FHA approved, and it's unique. You cannot borrow funds for the down payment like you can in a conventional loan. So that's one thing that's pretty unique about the reverse mortgage. We just got to pay attention to. And we're going to talk about required counseling and financial assessment in a minute. Repayment is due when it's no longer their primary residence, or they default. No longer their primary residence when they pass away or move into assisted living or something like that, permanently into assisted living. A default is not maintaining the property or keeping current on property charges. The amount received is based on age, the lower of the appraised value or the loan limit. We'll see that in a minute too. And the product chosen and the interest rates. This gives you an idea based on age what the contribution from the reverse mortgage might be. And the bottom shows it in percentage terms. So at 62, the reverse mortgage will contribute over a third of the value of the home. If somebody 85 could get up, a little over half. So that's what it changes based on age. The reason that, here you have a $750,000 home and they get a little more than half. Why they don't get the full amount is the difference is the reserve set aside for the accumulation of interest and mortgage insurance over the expected term of the loan. And so that reserve is necessary to make sure that everybody gets paid off in the end. Note, I made and highlighted this, values over $1,089,300, and that's for 2023, would be computed as if the value was the max for the standard program. So if it's $1.6 million home, but we're using the standard program, all the numbers would be based on $1,089,000. And as I mentioned earlier, the jumbo program goes to $4 million. This is an example of how to help a client get to be where they want to be. These folks are not fully retired yet. Rachel and Sam bought a second home out of state with the proceeds of a refinance on their current primary. They will continue to make payments as if because they're still working, and it keeps the interest accumulation down. And they get to enjoy the home now. They Airbnb it when they're not on vacation or visiting it. And basically they fix the price of their retirement home. The plan is to sell, and now we're a couple of years into it, so in 5 years, and at that time they're going to sell their current primary that has a loan on it. That gets paid off. They might be a little bit of proceeds. I think they're planning on fixing up the thing to their liking with funds that they will have selling their home, and they sell their Bay Area home, and they sail into the sunset. They love this. When we talked about it, we started with this client originally wanting an equity line, and they didn't know if they could afford it and all this sort of stuff. And when we said we could do an equity line that had optional payments or no payments, and they jumped on it. One of the nice things, Rachel said, wait a minute, we get to enjoy our second home now while we wait to retire, and then we can move permanently. You got me on that one. They love that. Okay, the challenge is the old way versus the new way of thinking. And I get it. It's a generational thing, as we've talked about, with a mindset they have to have a paid off home in retirement. But with $12 trillion in housing wealth, might be the catalyst to think about an opportunity and understanding the main need is a zero mortgage payment. So instead of buying a home, finance, save for retirement, pay off mortgage, and leave house to kids, the new way is buying the home, finance, and save retirement, but utilizing home equity as a resource for a better retirement and leave house to the kids. Now, and you know what? 100% of the time, we always try to involve the kids if the parent wants, and 100% of the time, the kids are really supportive of the parents living a better retirement as opposed to passing a legacy along, or a greater legacy along. And the numbers will always work out pretty well, I think. Even the most well-prepared client can accomplish retirement goals with a reverse mortgage. How often have you talked to a client or seen a client take out an equity line to help a family member with a down payment? Well, how about an equity line that they don't have to make payments on? Well, that sounds like a win-win all the way around. They might be more likely to do that and able to, and not likely, but it's really able, because the kids are going to get it anyhow. It's kind of the approach, but in this way, they can help a kid with a down payment, perhaps, or and it's on a reverse mortgage, and they don't have a cash flow crunch for the parent. We've had clients that buy that RV they've been dreaming about, again with no payment, assist a family member with a large expense, a home or grandkids, college, that kind of thing. We've had clients fund a home and renovation projects. One did an ADU, so built an ADU, very nice one. Parents moved into it, moved the family and the grandkids into the main house. Very happy grandparents. And also little things like you can build a financial bridge to maximize Social Security, so you can be retired, use some funds for a while till you get to 70, when the reimbursement for Social Security is much higher and more valuable, and then cut down on the reverse mortgage, continue on. So lots of good applications of the reverse mortgage. Clients don't act because of uncertainty, and if you can help show them a path how to get there, it'll work. I mean, we have enough stuff going on that it does create uncertainty, but the market's really good now, still low inventory. And one thing to know is once the reverse mortgage is in place, it can't change. And we can address these concerns in a positive way. Education's the key, and I spend most of my time educating, and then the transactions just follow. And not everybody, it's not appropriate for everybody, and I won't do it for everybody either. So understanding how it can be applied and serve the client throughout the retirement is key. And that word throughout the retirement, I don't just do loans that, I don't talk anybody into a reverse mortgage. It works or it doesn't. And what I've found is even with the education, it doesn't work right then, but they've got it in their head. The more they think about it, then they come back and we make it happen for them. And honestly, just the education and exposure has resulted in referrals. So we've been successful with even the most negative realtor and financial planner when we start out. A lot of people have a negative perception of reverse mortgages, and if you talk through it and have a better understanding, it works really well. And the focus is education. The steps include independent counseling. So it's done with a third party that's authorized by HUD to make sure that all the opportunity to ask questions and to make sure some of the basics are covered. There's a financial assessment that's required to make sure that the ongoing benefit of the reverse mortgage will stick. And then there's an appraisal and submission and details, and then close. And it closes very much like a conventional mortgage. I go much deeper than what the financial assessment requirements are right now. Our client I'm working with now, actually, I made them complete a full budget down to the smallest detail before I would recommend or proceed with a reverse mortgage. In their case, they had numbers here and numbers there, and disability was going away. So I made them budget based on their future income and what they pull out of their IRA and all that, and what the reverse mortgage could contribute. A very nice balanced budget, but they know what they'd have to do to be successful. And that's really important to me. I'm a CPA and just think numbers, and I want to make sure that works. Purchasing a home with a reverse mortgage doesn't help someone in retirement if they struggle, and I'm not going to do it. The most troublesome clients are what I call spendthrift clients that just spend, and they look at the proceeds from the reverse mortgage as being this huge benefit. And it's a tool, and it's your home equity. It has to be spent wisely. The consumer safeguards are really important. The program is tightly regulated. Every borrower must attend counseling from an independent party designed to be sure a clear understanding and that all options were considered. Origination fees are now limited based on a formula from FHA tied to loan amount. And the financial assessment I referenced is required based on the number of people in the home, square footage, and then a little bit of a cushion. Additional safeguards. The loan is non-recourse, and that benefits the client in that they never owe more than the future value of the home, and it doesn't become a burden of on their estate or their heirs. In 2006, the first HECM I did was for my aunt. Prior to that, the loan amounts in California were 200 some odd thousand. They didn't make any sense. But for her, we paid off her mortgage, and she received $600,000 on a monthly basis. And she lives in Stockton. The values got crushed, and her home's underwater. Still, she gets a monthly check, and will for as long as she lives in the home. Another good change addressed a non-borrowing spouse, and that means they may be under 62 or got married after the loan was done. They will still be able to stay in the home in the event that the borrower predeceases them. Just like any other mortgage or home equity loan, the borrower continues to own the home. These are myths that we hear, and their name remains on title. No difference. The homeowner cannot be foreclosed upon as long as they meet responsibilities to maintain the home and keep current on all property charges. Clients decide what is to be done with their home when they are no longer there. The heirs or the estate can refinance and pay back the loan balance and keep the home, or they can sell the home, repay the loan, and receive any remaining equity, or in the unlikely event in California, except my aunt, do nothing and deed the home over to a lender if it's underwater. Those are choices. The industry itself is also highly regulated. Any lender offering reverse mortgages must follow strict state and federal guidelines and regulations that are in place to protect the borrowers. Members of the National Reverse Mortgage Lenders Association, NMLS, pledge to hold the highest ethical standards. Of course, I'm a member. In recent years, there have been a number of product advances that have made reverse mortgages more attractive, and academic researchers at respected universities have developed effective strategies for using a reverse mortgage as part of an overall retirement plan. Too expensive, the mortgage insurance on a reverse mortgage makes them more expensive than a non-FHA loan. We'll talk about that in a little more detail in a second. Reverse mortgages can help improve retirement outcomes in more ways than purchasing a home with a reverse mortgage. Accessing home equity can replace income as a result of the loss of a spouse, loss of employment, or temporary issues. Also can be a voluntary, such as someone choosing early retirement, and they say we can do this because they can balance their budget with the proceeds from a reverse mortgage that pays monthly or in the credit line or whatever. Accessing home equity can also help offset increasing expenses and the unexpected items that always happen. Medical expenses can be covered. Other expenses, some of them are self-funded, so you got to watch out for those. They'll catch you. Establishing a credit line early that will continue to grow while the market recovers. We won't get in that detail, but it is a positive function of the reverse mortgage. We can draw from the reverse mortgage and market turndowns, the line of credits available for any purpose. We really want to increase the probability of success of a retirement plan and leave more estate to the heirs, a better legacy. Listen, a gray divorce, I have 2 of these loans going right now. It happens later in life. A couple wants to separate, but want to take care of each other as well. The marital home is a shared asset, and using a reverse mortgage both on the existing home and perhaps on the new purchased home can create assets and flexibility without a monthly mortgage payment. Let's see, we got off track there. There we go. As mentioned, the mortgage insurance paid up front is the expensive part of the reverse mortgage, but it provides a significant benefit in that the loan is non-recourse. The example I used with my aunt, her house is underwater. The house is the security for the loan. Her estate's not responsible for anything more than the house itself. But since the loan is non-recourse and the insurance fund covers any potential losses, the rates on the HECM loans are low because the investor doesn't have to worry about getting made whole or getting their money back. So a home valued at about $1 million would have $20,000 in upfront mortgage insurance. Big numbers, big benefits. We kind of subsidize middle America, where we are used to appreciation, not necessarily the case in kind of middle America. So it's a national program. We all have to pay that. Rates are kind of consistent with a conventional 30-year fix, so that's good. Available funds, interest rate, and the cost of a transaction does vary based on the youngest borrower's age and the value of the home. Most fees are rolled into the initial draw on the loan. Costs due up front for counseling and appraisal that are the borrower's responsibility up front. Hey, you are the hero and we respect your client relationship. We'd like to be part of your team and be the resource and sharing this opportunity with your clients. One thing to keep in mind is often the first contact when we're talking about reverse mortgage are the children of a senior. They're the ones that don't want to, they want to provide the best opportunity for their parents. I'm not new to reverse mortgages. The principal limit was about $230,000 when they started tracking, but then they started tracking the FHA expanded conforming loan limit, and then it became worthwhile and viable in California. I've helped 107 107 families. We're a broker and have access to all the leading lenders, so we get the right options and pricing that will be to the advantage of the client. So far, we've helped clients access, I know it says 41 million, it's actually $44 million of home equity. We just closed a $3 million property in Sausalito. That was a big one. I've made the investment to be a CRMP, one of the only 290 in the country. That's through the professional association. And I'm connected with a small group of the best brokers in the country that we meet every Thursday to kind of talk shop and to really, and we dig into issues and things that opportunities that we can do help clients. I'm hopeful you found this valuable, and there's a couple ways to continue the conversation. I'd love to have a one-on-one where we can take a closer look at examples that you may be thinking about. And also, if we want to spread the word, I'd love to participate in your office meetings or study groups and share the love here. We are a broker. Anything to do with residential financing, we have a long list. We don't come to the table with one solution as a reverse mortgage specialist. We come with the best options for the client. And retirees do often move from California. So we do have the entire Western states covered, including one of my associates covers Nevada too. So we can help. For those leaving California, we can help. Retirees should not be making new home purchase decisions without understanding how a reverse mortgage could help them. Don't let them go figure it out on their own. We can make it happen. We can help make it happen. One more thing, there's lots of folks in the industry that don't have an understanding of the HECM for purchase and don't realize, you're going to a listing and presenting an offer, and the listing agent doesn't realize it's a 30 to 50% down payment. It's a pretty secure loan, and qualifying is, we're really confident when we pre-approved a client. So that's how I start with the listing agents that are hesitant about a reverse mortgage. Help us spread the word. And that's it. And again, thanks so much for your time. I will deal with some of the questions that came through directly via email, and keep in touch. Again, thanks so much. I look forward to hearing from you. You take care.